All right. What is up, everybody? This is Teddy. This is Volume 101, and today we're going to be talking about volume trading setups. We got a bunch of setups to go over today. There's going to be some that are price based, some that are volume based, some that are volume profile based, and some that combine all of those things. Wow, I had a little thing, little thing pop up on my screen there. I had to exit out of it. But anyways, this is going to be where you guys learn the money makers. So these are going to be the things that are actually able to make you money rather than the other things we've talked about. You know, they're parts that you could implement to make money. This is kind of the where everything comes together and you really get to dive in and actually find setups worth trading. Actually find setups that are going to produce money for you, that are going to produce winners for you. That's not to say that these are going to work every single time. I want to start the class with that. These are not going to work 100% of the time. These are going to work 60% of the time, 65% of the time if they're really good. These are just giving you an edge over the rest of the market and over kind of the variance that can occur. So let's do our best to stay focused throughout this entire presentation. I'm thankful that we have all of the viewers live. We got 12 right now, and I'm thankful for everybody who's watching this as a recording. So thank you guys for tuning in. I hope you guys learn a whole bunch of stuff about volume trading setups, and yeah, let's hop in. Table of contents today. So we only have 5 sections today, so it might be a little shorter class than we previously had. Yesterday ran a little bit long. We got upwards of that 90 minutes. Today, only 5 sections, so we might be able to kick this thing down a little bit. Number 1 is going to be classic volume. So setups that are for classic volume, setups that OG volume is going to be the main reasoning that we're talking about. Number 2 is going to be volume profile. So volume profile is going to be the main reason that these setups work out. Number 3, combining setups. So when you have classic volume and volume profile and maybe price, we're going to combine them. Number 4, classic setups plus VPA. So these are going to be things that you guys have heard the names of before, you know, double top, a couple other names, flags, I believe, pullbacks. Classic setups that we can add VPA onto to make more effective, because why would you not want your setups to be more effective and have better play selection if you can? So anyways, and then we're going to wrap it up. Number 5 is the wrap up. You guys, questions in the camp chat, as always. If you're a live viewer, then you guys are getting used to this. We're day 4 here. Questions in the camp chat. Let's kick into it, and yeah, let's get going. Number 1, classic volume, which is just that OG volume that we talked about on Monday. And these are the setups that could be useful to you guys that use classic volume. The first one we have is a high volume break. So this is when a key level is broken and it's paired with high volume. That is what I consider a key level break. So you guys can see the black line here. That's our pivot level or our key level. It was a support previously in the day, and there were a couple other bounces earlier on the chart, but I couldn't fit that onto the picture. But it was a support here on this red candle and then this bounce. So it was a key level. We broke that level with very, very high volume. You guys can see the volume on that very, very large. It pretty much is higher than any other volume candle previously throughout the day. So it's very, very high, and we consider that a very strong volume surge. The reason that this is such a good setup is because it requires a lot of strength to break a key level. And so if they show us high volume on that break, we know that they have the strength to continue moving price. So they showed us, look at this, we have this high volume, we have a lot of selling orders, and we're going to use them to break this key level. They used them to break the key level, and now we know that they have a lot of sellers interested in the price and interested in continuing to sell this. Pairing it with high volume is basically what validates it. We talked a lot about candle validation yesterday. So the high volume here validates this candle. You got a large result, you got a strong result out of the candle, and you also put in a lot of effort with that high volume. And when we're talking about key levels, you know, this could be high a day. Low of day is the situation that this example shows. It could be an EMA. It could be VWAP. It could be a shelf. It could be a fib. Any of those things can work as a key level. And we're going to talk about entries today. Most of these examples, I'm going to explain to you where I would have entered. Exits, a little bit different story. That's going to be a lot different based on what your strategy and what your rules include. But exits, for the most part, for me, I'm taking them quickly within a few candles. And I'm also taking them, 10, 15% on options I'm very, very cool with, which probably not something you see a lot. A lot of people are looking for massive moves on options. I'm not that kind of guy. I'm looking to stack a few 10 percenters, a few 20 percenters on top of each other and take those base hits and then make sure that my losers are small. That's how I play options. When it comes to futures, it's pretty similar. A couple candles move in my direction, I'm going to be out of the play. So entry on this specific example, which is the high volume break, should be on a pullback after our high volume break candle closes. So when that candle closes, it means that that break is set in stone. If we were to try to enter before it closes, you could end up with a situation where a wick forms on the lower side and the break is kind of iffy at that point. So we wait for that candle to close and then we look for a pullback. In this case, we get that pullback. It ends up being 1, 2, 3, 4, 5, 6, 7, 8 candles long. So it's a pretty long pullback, a lot of entry opportunities on it. And there's not really any volume, surges during that. So you don't really have to feel uncomfortable about the volume during it because it's much lower than the break that we saw of that key level. So the volume is declining and the volume is staying pretty low. So you enter on that pullback and then you guys can see the play out that occurs. These 3 candles here. I believe this is a break from day to day. So I believe this is one day and then this is the next day. But anyways, these 3 candles would have paid you more than enough. If you wanted to hold overnight, you would have made even more. But, can't always hold things overnight. Sometimes it doesn't fit your strategy. Okay, number 2 is going to be a declining volume rally. What I mean by this is when price is increasing while volume decreases. And this example is pretty much textbook. So you see the price here, it's increasing. We're slowly seeing a few higher lows here. So price starts right in this 494.50 area, and then we get all the way up above 495.50. So we move over $1 while price is declining. And you guys can see I've marked this price decline with this upper trend line on the volume side of things. What we can tell from the volume here is that the move to the upside is weakening. It's not getting stronger. If it was getting stronger, we would see higher volume. We'd see breakouts there with larger volume. We have a question here. Which candle would you enter on within the pullback and why that specific candle? So let me go back to this example here. Which candle would I enter on? In this example, I don't really think there's a right answer to that. And I don't really think I would have a real gripe about which candle. I think probably just one of these first 3 green candles I would feel comfortable entering on. And then I would want to just hold until, either we broke back above this key level or we broke down, which we ended up breaking down in favor of the setup. But I would say one of these first 3 green candles. This 4th one I don't like as much. And that's why I would not enter on that one, just because the volume's a little higher. It's not a volume surge, but it's a tad bit higher. But these first 3 green candles, much lower volume, declining volume, just matching the fact that this is a pause in the trend before the trend continues. So I'd enter on those, and then I would have had a stop loss somewhere up here, and then taken profit on those green or those reds. Okay, so we'll pick up where we left off. I appreciate the question. If you guys have any other ones, drop them in the camp chat, as always. So buyers are slowly becoming less interested at this higher price. So we see, the move to the upside, these higher lows, the dips being bought up, but just with declining volume. The dips are not being bought up with a lot of aggressiveness. And that's a word that I think can be used to describe volume on this situation pretty well, is when these dips are getting bought up, we want to see it be aggressive. We want to see the dips, getting eaten up with volume, with interest. And this is just showing us that buyers are not as interested in the price as it increases. So we started lower, and as price pops up, the buyers are not feeling it. The buyers are not saying, okay, I want to keep buying and keep pushing this price up. What they are saying is, let's sit on the sidelines and just watch this play out. We never want to enter along when the buyers are showing us that they're willing to sit on the sideline rather than enter, be aggressive, put in buys, block buys, move the price up. When they're not showing us that, we do not want to be along. In this situation, we could be a short. And we're going to talk about what makes this a better short pretty much right now. So the door has been opened for sellers to take control by the buyers not confirming that this is a strong move. So they have not confirmed that, okay, this move to new highs is significant and is strong. They've confirmed none of that. That leaves the door open for the sellers to step in and move to take control. And when we enter on this, usually I like to enter after sellers what I call announce their arrival. And that means the high volume, the break of that uptrend line, the little surge in volume that we see, which is right here. So we have this decent sized candle, so the body is pretty large, and a nice increase in volume. It breaks this downtrend line that we have in volume as well, which is pretty important. So after this, I would have probably entered after the candle closed on this next red candle. I'm not sure if they would have given much of a pullback to start the candle, just a little green or not, but it's a pretty small candle nonetheless, so I would have felt comfortable entering on this red candle. And then you get a decent immediate play out. You get one and then a pullback and then again. And if you were able to hold through this, you would have made a lot more. But just knowing me personally, I would have probably taken a little bit of profit after these two decent sized red candles. But I want you guys to know that the main entry trigger here is when those sellers announce their arrival. And it can be in a different form. It could have been a rejection candle. So maybe it made new highs and then they rejected it with high volume. That would announce their arrival as well. But in this case, it's this solid red bodied candle, which is actually pretty big compared to what we've seen the previous 1, 2, 3, 4, 5, 6, 7, 8, 9 candles. You'd have to go back 10 candles to see something with a body that size. So they're announcing their arrival. They're showing us that they're here, and they're showing us they also have the selling power to pop that volume a little bit because they popped it above that trend line, and then they continue it to the downside. Okay, so this is one of my personal favorite setups, the low volume pullback. I talk about this a lot. This is an example that I like, but I don't love, and I think that might actually be better for explaining terms because it'll let me talk about the things that I don't like about this setup that maybe could have been better so that you guys can see what an A+ setup would look like for me. So when a strong move is followed by a low volume pullback, that is what, some people call it a flag. Some people call it a 3-bar. Some people call it a low volume pullback, whatever you want to call it. I just prefer low volume pullback. And what this indicates is that sellers do not have the power to reverse price. So when they announce their arrival, like in that last example, we're talking about the volume. They're announcing that, oh, look at this. We have enough to control the price and push it down. In this situation, it's the opposite of that. They don't have the power to announce their arrival and show a nice high volume rejection or high volume sell-off. So essentially, it is a fuel up for the current trend, especially if that trend is strong. So the first part of this is that trend before our low volume pullback needs to be strong. This one here in this example is pretty strong. You get this 3 candle increasing breakout, I guess, because there was a small resistance here. You broke out, and then this next one is still high volume compared to the previous candles, but it's not as high as this one. And that's my first issue with this setup, is I would have loved if this last candle here was the same volume as this previous candle. It's not, but it's still high. That's what we can kind of hang our hat on, is that it's still high. Still higher than this red surge. It looks pretty similar to this red surge. So the previous 1, 2, 3, 4, 5, 6, 7, 8, 9. The previous 9 candles, it is higher than. I wish it would have been a little closer to this, but nonetheless, it's still an okay setup. My second issue with this setup is that we broke to new highs and then began the low volume pullback. That's not a deal breaker for me when it comes to low volume pullbacks, but it is a little bit of a, I wish that wasn't there. The good things about this setup, number one, are that the flag pull is very strong. The upper wicks are very small on this flagpole, or this trend, this green trend that started this setup. So the upper wicks are very, very small. That's a very, very strong part of the setup. The other thing is this second red candle on the pullback has a lower wick. It shows that buyers are starting to push up in this, and they're showing a little bit of interest in the current price. The other thing is the beautiful declining volume of these two red candles. So the sell-off has low volume. It's approaching the lowest volume of the day. And then we get this small green candle, which is almost a part of the pullback as well. But then the breakout candle, high volume, highest volume since, I think that might have been the opening candle here all the way at the beginning. But the highest volume since that, broke to new highs. Beautiful, beautiful candle. So the setup was pretty good. It's not a A+ level. It's more like a B+ or A level setup, but it's pretty good. And I wanted to give you guys a little bit of an example that maybe wasn't the best possible example, so you guys can see what I would see in this, current situation, or what I would want to see to make it look better. This one, if you're going to take a few things away from it, take away the strong trend, the declining volume on the pullback, and then the higher volume on the breakout. Those are the three things that this kind of should show you, and you guys should keep in mind. Entry on this: 1 to 3 low volume candles would be the perfect entry. So the first one, usually I'm willing to sit past the first one. I'll watch it close, and then I'll look to enter on the second or the third candle. Here, you would have been good to enter on the second candle or the third candle. Probably the best entry here would have been on this small green candle, due to the fact that we saw this lower wick and buyers starting to push the price back up on that second red candle that we see here. So this green candle would have been the perfect entry, and you almost would have made immediate money. So after 1 to 3 low volume candles is when you want to enter. Okay, the next one is a high volume bounce. And you guys can see I've got an arrow pointed right towards that high volume bounce. And you guys can also see that the play out was almost immediate on this one. It was pretty nice. So when price bounces with high volume, that's a high volume bounce. Pretty much what the name is. So sellers attempted to continue the move down in this example, but then buyers stepped up and defended a level with strength. And we know it's with strength due to the high volume. We know that buyers also consider this price to be attractive. So not only have they kind of put their line in the sand, they're also liking the price because they were able to close this candle green and with that long lower wick. It requires stopping power to create a wick like this. So that usually means that they have more buying pressure. And also, you guys know that the price is lower than it was an hour ago, which is usually also attractive to buyers and bulls. They find lower prices attractive. So when they show this stopping power, usually that's kind of a key to us that, okay, they're ready to enter and ready to start deploying their buying pressure. When we're talking about entry after this, we have to let that lower wick candle close. Once it closes, what I'm looking for is the next candle, so this green one here, to give us a small pullback where there's a little bit of red that I can buy. I strongly dislike buying longs on green candles and buying shorts on red candles. It feels like chasing and FOMO to me. So I love when there's a small pullback on a green candle to give me entry, or a small pullback on a red candle to give me entry. And here, looks like there was a perfect example where there was this little tiny wick on the bottom side. That's where I would have preferred to enter here. The reason I like that as well is because you have this low very close to that price. So you would have gotten in on this wick, and then your low of day like zone starts at the bottom of these candle bodies and goes to the bottom of this wick. So you have an immediate support right below as well. So you can put a stop loss right below that support. So if it breaks support, oopsies. If it breaks support, you can exit out of it. And then you have also a lot of targets for the upside. You have this little support here that could be resistance now. You have this high a day up here. You have a few different rejection spots, 1, 2, 3. So a lot of different targets here, but entry on the small red pullback that you get on that next candle. Okay, so a highs rejection, pretty much the opposite of what we just saw. So high and low, they're important levels. We just saw a low there. We just saw the bounce that happened on that low. This is the opposite direction where it's a high of day rejection, and they're very, very important. All the rejections that you see at high of day or at low of day are extremely important. The difference between these two is this one, there was no low of day in this area established before this touch. This was simply new lows and then bounced. This one here, there's already a high of day established in that area, and then we rejected a second time. So the high volume on this rejection, which it's high compared to 1, 2, 3, 4, 5. I believe that's 6. I think I counted that wrong. Yeah, there's 6 candles previously with lower volume. So you get this volume surge. It's higher than the previous 6, and it rejects that previous high of day. So you have this high of day level. We came up, we tested it, and then sellers came in and defended that again. The sellers were able to completely overpower the buyers at that high a day level because they closed that candle red, which is another good sign for the bears there. Again, this entry is going to be very similar. It's going to be on a pullback on that next candle is what I'm looking for. And this next candle actually closes green with the lowest volume of the day. The best possible entry opportunity that you could possibly have in this situation is this example, where you have this nice high volume rejection and then the lowest volume green candle of the day comes next. You load the boat on that small green, and then you could have already sold 2 candles later. You could have runners left and then just watch the thing continue to bleed. Just depends your trading strategy. But entry very clearly and very easily is this green candle here. Okay, so control, volume control. This is a pretty much only classic volume setup. It's when one sentiment is consistently showing volume surges and successful candles. So we pair the volume surges with successful candles. You guys can see in this example, I have labeled the bottom side green volume surges plus strong green candles. You can look at what the candles are paired with these volume surges. The first one being right here, and you can see that high volume, long bodied candle there. There's a little bit of an upper wick, but it's not significant. The next one is a bounce candle where they made new low, and then buyers defended that level and then closed it at new highs. Well, for the candle, sorry. And the next one here is a breakout candle where we broke above this resistance area and we closed with a strong body. Next one here is another breakout candle, broke above this resistance, and we closed with a nice body and small wicks on both sides. So the volume surges, those are the successful candles. And then you guys can see after that, you know, the pullbacks. So this red candle here, this red candle here, these 2 red candles, this red candle here, they're low volume. That's the important part of this, is you're pairing the high volume successful green candles with the lower volume red candles. What that tells us is that sellers are unable to match the buyers' aggressiveness and strength. So the buyers are strong, they have a lot of buying orders in their reserves, and the sellers are just not able to match it. They're just not able to, you know, create the amount of volume necessary to reverse the price. So buyers continue running the thing. You have many entry opportunities on this example as well. You could have entered on this this high volume lower wick here. You could have entered on the pullback after it. You could have entered on this red lower volume pullback right here. Could have entered on this flag here. There's about 3 good entry opportunities, maybe 4. 1 here, 2, 3, 4. Where it's low volume pullbacks, smaller candles, and much, much lower volume than the surges where the strong green candles were paired with. So basically, take your pick there. Okay, so we are through classic volume. I'm gonna grab a drink here quick, and then we'll get into volume profile, which we're gonna talk a lot more about shelves and deserts. Okay, so volume profile, this is going to be section 2, and let's hop into it. Number 1 is going to be a cliff break. And these are difficult, guys, to find in real time because volume profile is always changing when the volume comes in. So I used arrows on these because I was searching through, and the more you like change the time frame, volume profile just changes, and it was just difficult to find examples, and I got tired of constantly trying to manipulate the time frame I was looking at. So I just used arrows. But these things do happen. So watch your volume profile in live time, and you'll see these examples play out a lot more than you will if you try to go back and look, at previous days, because as the day goes on, your deserts start to just get filled up with chop volume, and your cliffs start to look like less cliffs. So it just kind of gets a little murkier as the day goes on. The early morning, we have really nice cliffs usually, really nice shelves, and really nice deserts. So keep an eye on it. During the morning, I guess the first 3 hours of the day, that's when you should keep an eye on the volume profile. Okay, so a cliff is that area where it has a steep drop off. We talked about this on Tuesday, I believe, but this is our cliff here where I have the annotated cliff little section where it's this steep drop off where it happens very quickly and it essentially looks like a cliff. The sellers are going to defend that level due to the easy path above if the cliff breaks. So if the cliff is broken and price moves above, there's a lot easier path for bulls than in this area. There's a lot of resting orders. There's a lot of seller interest in this area. So bears are able to defend this area easier. So when we're looking at this, usually you're going to see a pullback on price near a cliff because it's going to get defended. That's when you can kind of gauge the strength of this, is how bulls react to that dip. So we get this move into the cliff, they reject it slightly, and then we break through that cliff. That's what we want to see from a strength perspective, is the bull's able to buy up the dip and then continue through that cliff. We want to enter when it breaks this cliff with high volume, or if it comes back down and retests the cliff. So we break through, we close a candle with high volume. That would be a potential entry place. Or we break through, we come back and test the cliff, and then we bounce. There's your entry as well. We got a comment in the chat here. Tangy says, yesterday on SPY, where it chopped lower all day, there was a cliff that broke and SPY rocketed to the upside at the end of the day. Hell yeah. That's the type of stuff that you guys should be looking for. So props, Tangy. That was a good eye. I didn't even see it. So interesting, though, because those cliffs, I don't hear a lot of people really talking about them, especially technical traders on Twitter. I don't really hear a lot about cliffs, but that's probably one of my favorite things, is when I get VPOC and it also is a cliff. When that thing breaks, usually you get a solid move to the upside because the bears really exhaust themselves defending the cliff. And then once it breaks, they don't have a lot left in the tank. Okay. A shelf bounce is our second volume profile setup. So a shelf is the high volume areas on the volume profile. We talked a lot about that during the volume profile class, but we also have it annotated here on this example. The shelf is this lower area where there's this high volume node, this little group of high volume nodes. And then it's also another shelf up here where we have this high volume node here. So when price tests a shelf, there's going to be tons of resting orders and also just previous buyer and seller interest. So we know that when price hits this area, the buyers and sellers, they both kind of try to fight about it. When price hits this area up here, the buyers and sellers, they just kind of fight about it. So when they're defending these shelves, that's when we can see that a bounce or a rejection is likely to follow. So, if price comes down and tests this shelf and then the bulls immediately react strongly, that's when we would want to enter. That is when you know that a shelf bounce is occurring, is when they respond strongly, when they respond aggressively. Same thing for if price approaches this shelf from below and sellers step in with strength and with aggressiveness and urgency. That's when you want to play these shelves. If they just respond with a low volume bounce, stay away, because that shelf could also break, and we're going to talk about that in a little bit. Like I was just saying, your entry should be on once a bounce confirms with volume and or price success. So I'm talking about things like an engulfing candle with high volume, or a high volume lower wick that touches the shelf and then bounces to back to where price was. Those sorts of things should be confirming your entry, not just, oh, this is a shelf, I'm going to enter because I see this shelf, here. If there's nothing else behind your entry, that is going to be an awful decision. You have no confirmation that price is actually defending that shelf. There's times where shelves are going to get knifed right through. There's times where shelves just aren't going to work. So you need to have confirmation that that shelf is working. Similar to a support level. You need to see that that support level is starting to work out before you just jump on an entry. There's no reason you should be blindly buying longs on support or blindly shorting at resistance. See those supports and resistances start to work and then buy the long and then take the short. That's a very, very key thing that people usually overlook. Is the blind entries are usually the ones that get you caught up in a bad play, down a lot. So all of a sudden it knifes through and you have no idea what to do now. Okay, so a desert rally. The deserts are the low volume areas between volume shelves. So we have this low volume area between shelf number 1 up top and shelf number 2 down here at the bottom. In this area, price has historically lacked interest from buyers and sellers. So we know that there's buyers in this area and we know that there's sellers in this area, but in this middle area, they're just not as inspired to be buying or selling. They're not as interested in taking trades in that area. So when price moves into that desert, it's likely to follow the trend that it began with. Sometimes there will be rejections, as always. Sometimes setups just don't work. That's just how trading is. That's just how the market is. But for the most part, deserts get moved through quickly. And it also takes strength to get into a desert. Usually it has to break through a shelf. And when it does break through a shelf, that is a show of strength in itself. If we're able to get through this high volume shelf, it shows me that bulls are strong right now. So we move up into it, we kind of consolidate in this shelf, and then we break into the desert. That shows that the bulls had enough strength to get through this high volume area. They're likely going to have enough strength to continue through the desert. My favorite entry in this situation is when a shelf is flipped into support after it's been resistance. So in this example, it was resistance early. We got this small rejection. We break through, and then if we're able to turn that shelf into support, so we come back down, we test it slightly, usually that means we're about to slam through this desert. So once we flip that shelf, that's when I like to enter. Is the only time to take a blind entry after confirmation and you are just looking for a small pullback to enter? Or do you go to a lower time frame like the 1 minute and look for price action to verify that entry as well? No, I don't look for the lower time frames to enter. I don't really consider those blind entries as well. I think that when the confirmation occurs, it's not really a blind entry any longer. When I'm talking about blind entries, I think I'm more referring to when there's not been any show of a bounce or rejection. So like I was saying, in like a resistance, if there's no indication that bears have started to enter, that would be a blind entry. So if price simply moved into that resistance with strength or just with a candle and you decide to take short, that would be a blind entry. If we see that short side or bears starting to pile in, then that's not a blind entry any longer. So if price starts to get pushed down with high volume, then the blind entry is not blind anymore because you have a reason for it and that resistance is beginning to work. When I'm taking entry on, say, like those volume examples I was talking about earlier in this, I would typically wait for the candle to close, and that would take it from a blind entry to a non-blind entry. Once the candle closes and is set in stone in the direction that I like with the setup, then it's no longer a blind entry. I hope that answers your question. Gotcha. I figured that's what you meant. Just sometimes it feels like I'm trying to find too much confirmation all the time. Yeah, I definitely know what you mean. I've been kind of in that where you just circle confirmation and you just kind of keep looking for confirmation. What I would recommend is don't overthink your entries to the point where you have to go back to like a 1 minute time frame to look at entries there. If it looks good on the 5 minute, try to grab any moves against your setup you can. So if you're looking at a long and there's a small red pullback, grab it. Don't think too hard about it. Grab it. And then when that 5 minute closes, you can reevaluate. So, you grabbed that small red on that pullback. If somehow the bears come in and create a high volume red candle there and it closes with high volume against your play, you reevaluate and you'd probably exit then. But don't overthink trying to find an exact perfect entry. Just take what it gives you, because the market's going to oftentimes not give you as much as you think. So for me, that small move against my play is usually the best to enter on. And usually it's the one that I can just kind of enter, and I take personally 1/4 of a position as an entry, and I keep 3/4 position left to add if it continues lower. But I'm going to reevaluate that once that candle closes. That's kind of my strategy, and that's what I recommend. What is the difference between a cliff and a shelf? So you can see on these shelves, Paul, there's no real steep drop off where it's kind of like it starts, one candle is really, really high, and then the next one is about half of the volume of the previous candle. If we go back to the shelf example or the cliff example here, you got me mixing them up too. If we go back to the cliff example here, you can see that within 2 candles, this node is like 1/4 the size of what it was 2 nodes ago. This one right here is very, very high, and then 1 candle, 2 candles later, it's about 1/4. That's what we would call a cliff because it falls off very, very quickly. The shelves, they do not fall off as quickly. You can see it's more of a stair-stepping motion here. So you have this high volume node, and then it's slightly lower, slightly lower, slightly lower, slightly lower, slightly lower, all the way into that desert. So it's like stairs down. It's not quite a cliff. I hope that makes sense, Paul. Thought so, but how do you play them differently? So the cliffs are going to be defended stronger because it's a more important level. So this cliff break that we just talked about here, where the cliff breaks, if it's able to break, that is going to be more significant than the stair-stepping area of this shelf breaking, because the stair-stepping area, they're not really defending a very, very key part where it just ends. Here, they're going to defend this shelf area where it's the highest volume. So they're going to defend the highest volume in the middle of the shelf. And then the cliff here, they're going to defend this cliff because once it gets above, the area that they have to move through is much lower volume. And it's also a very, very defined level, the cliff is. When on the shelf, it's just much less defined. There's not a specific level where you can draw a black line and say that's where they're going to defend. It's more so the middle area of a shelf. Okay, I think we got one more in here. Jordy said, would you consider that second little shelf from the top to be substantial? Do you have any way to gauge those mini shelves that can sometimes appear in the deserts? So you're talking this little shelf here. Is this little one substantial? It's substantial enough, Jordy, that I would begin to exit into that shelf. Not because I think it's a particularly strong shelf, but I also know that price sometimes moves funky, and I also know that the bulls had to use a lot of buying orders to get up into that shelf, and so they might be tired by this shelf here. If they're tired by that shelf, it could be a possible rejection area. I usually play it on the safer side of things. If I had to say, where is this likely to move once it breaks through this bottom shelf, it's probably going to move up into this top shelf. But I'm more likely, the smaller the move, the more likely I am to be able to capitalize on it. So I'm going to take some profit into this top shelf. I would just gauge them based on their size in comparison to the shelves, Jordy. I would just kind of look as in, okay, so this one, And the peak is about right here, and the peak of this one is all the way over here. It's about half the size as this upper volume shelf, and similarly, it's about half the size as this bottom shelf. So it's not always going to work out, perfectly to say, oh, it's half as strong, because, buyers can step in anytime. Sellers can step in anytime. But you can just kind of relatively see that, okay, this shelf is about half the size as the upper and lower shelf. Okay. VPOC here. We're talking VPOC, which is the largest shelf on the volume profile. So at any time, the volume shelf is your VPOC level. The biggest shelf is called VPOC, and all interaction with VPOC is going to be important. It doesn't matter if price is acting good, acting bad, up, down, sideways, chop, whatever it is. All interaction with VPOC is going to be important. Yeah, for sure, Jordy. Anytime. So when we get bounces, rejections, breakouts, and breakdowns around VPOC, they are all playable. I want to kind of stress just that the interaction with VPOC is what we're looking for. Usually VPOC is going to create large moves one way or the other. Sometimes, we'll get that chop around VPOC, and that's okay as well, because when it breaks, that's going to create that big opportunity for you. An entry here needs to be dependent on confirmation and volume price analysis. So again, essentially, VPOC can be played just like a desert rally, where you break above a shelf and it rallies into that lower volume area. It can also be played just like a shelf bounce. So these two previous examples can be used with our VPOC example. You could use, if it moves up into it and it bounces, to the downside, you can play it as a rejection. If it moves into VPOC and then consolidates and then breaks above, you can play it like that desert rally. If it moves into it from above and bounces back to the upside, it can be a shelf bounce. If it enters from above, consolidates, and then breaks lower, you can play it like that desert rally. But all interaction with VPOC is important. You should be watching any interaction that we see, whether it's early in the day, middle of the day, late in the day. You should just be watching it and just seeing how it works. And then I did want to talk to you guys entries and exits a little bit based on volume profile, because when I'm entering, plays, I am watching and looking at the volume profile almost always. And a lot of it is going to be this stop loss positioning. That for me is one of the big things that volume profile gives us, is a place that you can put your stop loss that is supported by real volume data, which is our volume profile. So what I have written is entering when a shelf is confirmed as support is key, and then I put confirmed again because that's very, very important. So you could enter right as it confirmed this shelf as support with, a strong bounce with high volume would confirm it as support. And then you can set your stop loss below the shelf. What that tells us is we have a key level between our entry and our stop loss. Nothing's worse than entering a play and then having a stop loss that is not supported by anything, and price just touches it and then bounces. But if you have a support level between your entry and your stop loss, that's very, very, very beneficial for you. Because if it comes back down, say you were wrong on your entry, or your entry was just a little bit early, it comes back down, it has a tough area to break before it even gets to your stop loss. It's going to have trouble with this high volume node area before it even touches your stop loss. And then I said exiting as we approach the next shelf ensures we avoid a potential rejection. So I have exit level right before this smaller shelf high. You could have had it right before this little smaller shelf high. You could have even had it, one entry or one exit area on this little tiny shelf. You could have exited your first leg here, then exited your second leg here, and left runners for this big shelf up here. It just really is up to you guys. But the big part of this is that stop loss below that volume shelf. Stop losses that are based on real data, guys. That is massive. A lot of times people don't have real data when they're entering, exiting, but volume profile is that data that we can use to put that stop loss in a correct area to where there's a support right above it. Okay. Next, we're going to be talking about combining setups. And confluence is very, very important when you're looking at trading. You want to make sure that If you're trading a double top, there's going to be something that adds to that double top and combines multiple setups to make sure that it's not just one setup you're playing. Because if you're only playing one setup, it's not going to be as good as if there were two setups in that situation, or three setups, or four, or five in your favor. So combining setups, very, very important. And also it can be, a game changer. Got a question here. Do you personally wait for candles to close under your stop loss, or do you stop out as soon as it touches as a hard stop, even if it might wick you out? It depends on the play, Tangy. Usually what I'm waiting for is my setup to break to stop out. So I've kind of talked to beginners before. I'm not sure your experience level or the experience level of people listening to this, but I think all beginners should use a hard stop. Once you're profitable, I think you can play around with your stop loss, but I think a hard stop is probably the best option for pretty much anyone who's not profitable. My personal strategy is I wait for a candle close to break the setup, and then I will stop out. I have basically a stop level, and if it were to close a candle below that level, then I will stop out. Also, I've also done it where I wait for a candle or two, and then I'll stick my stop loss in. So there is a little bit of added risk of not having a hard stop there, which I just absorb as a trader. I understand the risk. I know that I'm taking a higher risk strategy, but I do like allowing it to have that candle close before I stop out, because there's a lot of times where it'll wick up and it would have hit my stop loss if I had a hard stop. So I don't always, put that hard stop in for that reason. I don't like to get faked out. I also like to have confirmation that the play is moving against me, which is with that candle close. So short answer, I think beginners should use hard stops. And then I think that another question here. You have max loss in case it really dumps against you before it closes. Yeah, so I don't really hardly ever have it really, really dump against me. But my kind of thing that keeps me honest with that is I have a daily max loss, number one, and it's pretty small. It's about 1% of my account. And so if I hit that daily max loss, yeah, I'm going to exit. And yeah, I'm going to exit regardless. But also I have another thing in place, which is if I see volume coming in quickly, which usually if there's going to be a massive move against me, volume is going to come in quickly. That also acts like a stop loss for me. So if volume comes in against my play, so if I'm in a long, and let's just play out a little fake example right here real quick. If I'm in a long at $1 and my tentative stop loss is at 90 cents, and it comes down and it touches 95, and then I start to see volume surge into the downside and we're at 92, I would already be exiting due to the volume coming in between 95 and 92 cents, even though it's not to my 90-cent stop loss level. And that's just something that I've always kind of done, is if volume comes in against my play, I'm willing to exit immediately, because that's breaking my setup. Because when sellers come in against my play, I'm not in the position I thought I was. I thought I knew that buyers had control, and if they don't, and which can be shown by sellers stepping in, then I need to exit. So that's kind of my stop loss strategy. So it's a little bit complicated, and honestly, it's not something that I really recommend often. It works for me, but I know a lot of traders who have attempted to use it and have said, "This sucks. Why do you do this, Teddy?" I just want to use a hard stop, and so it is what it is. Whatever works for you as a stop loss, but for me, I was getting stopped out. And then it would wick up too much, I would say. So I was getting stopped out on the hard stops, and then it would bounce and it would rally and it would be, back in the profit too often. And so I wanted something that was going to take care of that. And so the candle close under my stop loss level really, really took care of that for me. And usually I would say, so I've done a little bit of analysis on this as well. So if I have my stop loss, and this is also theoretical, if my stop loss averages about 10% as a hard stop, changing it to that candle close under only upped it to about 11 and 11.5%. I believe it was like 11 point something, because I do an analysis on all my losses. And before I changed from a hard stop, I had like 10% pretty much average on my stop losses. And then after that, it was 11 point something something. So it was only 1% of added risk. But the reward I got of not being wicked out of things made me more money than that 1% per stop out. I hope that makes sense. I might have just word saladed that. But anyways, what I'm trying to say is it didn't make that big of a difference. So it was only that 1% of difference between where my average stop out was when I used a hard stop versus my average stop out when I used a candle close. All right, let's truck along here. I hope that helped. I hope that little tangent gave you a little info. Combining setups, like we already kind of talked about here, we're looking for confluence. So a shelf bounce and rejection, we've already talked about that a little bit, but these are the other setups technically that you could be looking for near those shelves. So we talked if price bounces off a shelf, but here you have, high volume wick, which down here we have the two examples, the upper wick and the lower wick. We have, I already talked about both of them. A shelf plus a double top or a double bottom, and that's what we have in this example down here, where it is a double bottom on a shelf or a double top near a shelf. So we're looking at, shelves being in these areas where this setup is forming. A shelf plus an engulfing. So say the shelf happened below this right here, and then the bulls step up and engulf. If the shelf was above current price and the bears step up and they push the price down, those are the setups that we're looking for in these situations. A shelf plus a high volume doji. What that tells us is that price is struggling to continue moving in the current trend, and there's a lot of indecision. You align that with a shelf, and it can show us that the current trend is ending. Okay, so the next one is deserts plus momentum setup. So we just talked about shelves plus bounce and rejection setups. This one is a desert and a momentum setup. So a desert plus a low volume pullback. So say in this area here, we had this nice move to the upside. We're in the middle of a desert. So there's a shelf up here at top and a shelf out here at bottom, and then a desert in the middle here. Low volume pullback plus a desert is a great setup, because that desert already shows us that price is likely to continue trending through it, and the low volume pullback kind of adds on to that we are likely to continue seeing the current trend keep moving, because the pullback, which in this case is the bears, they do not have the power to create high volume. So it's likely to continue that trend, which is the upside, and fill the rest of that desert. Desert plus control. So we talked earlier where there was the volume surges. So if we're in a desert and we see volume surges like that, it's a great setup as well. Desert plus a high volume break. So this right here, this little line thing here at the bottom is our example for the high volume break. So you can see the volume is rising on the breakout. So maybe we're consolidating near VPOC. Maybe we're consolidating near a volume shelf, and then we get a high volume break into that desert that we're talking about. And then low volume on the pullback, the retest here of this shelf. So imagine the shelf is in this red area. Pullback, touch the shelf, and we continue. All three of those are fantastic setups to just watch for during the day, guys. All right, so the last technical thing we have here is classic setups plus VPA. And this is going to level up those classic setups. So when we're talking classic setups, double tops, engulfings, all those sorts of things that you see talked about very, very often. If we can add VPA, we're going to make those classic setups have a higher win percentage than if we were simply just taking each classic setup without applying our VPA to it. So the thought process here, I already got into it a little bit, but combining classic setups with a VPA mindset is going to take your trade selection from good to great. These setups are known to work even without the support of volume. So a double top works out a lot, even if you're not looking at the volume. But imagine how well it's going to work out when it has the support of volume. So you're not going to be taking as many double top trades because now you have another criteria it has to meet, which is good. We want to have criteria for our trades to meet before we enter. So now you're only taking 1 out of every 3 double top where you see that the volume aligns correctly. That's going to make you have a higher win percentage and select the better double top setups. One important aspect of this part is just keeping it simple and fundamental. Perfect the basics of the VPA and these classic setups. So determining which sentiment has control and finding where the strength is, and then simply kind of leave it at that. We don't need to do any complicated volume price analysis stuff that includes formulas and numbers and exact data. I have seen some of it. I've talked to a couple guys who do it and swear by it. My brain's not built for it, I'll tell you that. I told them, wow, that's really interesting, but not for me. I'm sorry. So they can keep that. I don't think it would work for me. I don't know if it would work for you guys. So yeah, we're gonna be keeping it simple and keeping it fundamental. So a double top, like we've been talking, these are bearish setups, and we can add volume into this from basically the beginning of it. So the first thing we want to look for is the bounce between the tops to be low volume. So we have the first top here. We come back down. We create the neckline, which is where this bounce occurs. We want this rally between this neckline and the second top to be low volume. That is what makes this setup better, because that would be low volume pushing into a resistance area. The second thing we want to look for is a rejection on this second top to have high volume, because that shows that bears are stepping in and rejecting this low volume move, showing that they have more power, more reserves right now. The last thing we want to look for is this neckline to break with high volume, because this is a possible support level. If they bounce it again, that's support. If they break it with high volume, it's the nail in the coffin for the bulls, and the bears have shown that they have enough strength. All three of them combined, they indicate buyer weakness and seller control. So weakness here on this push, and then seller strength on the rejection, and then the break of the neckline. Next one here is a moving average bounce. It's also could work for exponential moving averages, or EMAs. So these MAs and EMAs are trailing support levels. So they follow price and they act as support or resistance depending on if price is above or below the EMA. And look for price action setups that align with the moving average. So an engulfing, wicks, double tops, double bottoms, higher lows, all that sort of stuff. And we want to look for strength, aka high volume, to align with those bounces. So an engulfing with high volume is the perfect example. So if price comes down, touches our moving average, and then a high volume engulfing candle occurs, that's the type of strength that we want to see here. It shows us, the most important thing it shows us is that our moving average is being defended with strength. So the volume shows us that the defense had a lot of buyers, and that's the most important part of this. A pennant break. This is also a very, very common setup that you see. And so I consider most pennants to be 50-50, and the break is going to determine which direction it will move. And I'm not talking about pennants where one side is flat. I'm talking about where they converge with higher lows and lower highs. If we have higher lows into a resistance area, that's a different type of pennant. I believe that's an ascending something, and then the opposite direction has another name as well. But when we get higher lows into lower highs, that is what I consider a 50-50 pendant. What we're going to look for on the break are high volume and strong candles. So if we were to get, when this breaks to the upside, if we were to get a massive green candle with a massive volume surge, that is the type of strength that we want to see on a pennant break. And then after that nice breakout, we want these pullbacks to be low volume. If they are high volume, that could possibly indicate a fake breakout and that the bears were finally stepping in to reject this back towards the pennant. What this is going to indicate to us is that the breakout was legitimate and supported by volume, aka buyers, and that the buyers have control of the price. That's what that low volume pullback is going to signal for us. trend lines here. The next one here is trend lines. These are similar to moving averages, but traders draw trend lines. So, traders connect 3 dots, make a trend line. And you're going to be looking for the same thing as moving averages and pennant breaks. We want to see strength in favor of the trend line. So these bounces, right here where we come down, we test this trend line and bounce. We come back down, we test it and bounce. Come back down, test it and bounce. We want those bounces to be signaling strength. If they signal strength, then it's possible that this thing could pop to the upside. It could be a support bounce and a higher lows bounce that signals strength to the upside. If these bounces are weak, say possibly they're just low volume or average volume, you could look for a trendline break. And when that trendline break occurs, we want to see strength in favor of that trendline break. So if it breaks to the downside, you want to see a heavy red candle with high volume. You want to see a heavy red candle and then a low volume retest of the trend line. And same for the upside. If this wants to break to the upside, you want it to have high strength from the buyers. You want it to break with high volume and then come back down, test that line and continue. Those are the kind of things that we want to see when a trend line break occurs. If you're just trying to play that trend line, the bounces of it, we want the bounces themselves to have high volume. Okay, so support and resistance. This is similar to those trend lines, but it's a little bit different, as in support and resistance can be sideways. They can just be up and down, parallel to your x-axis. And we want to see sellers winning the battle near resistance. That's going to be the first thing that we want to see, is on the rejections that occur at the top side. We want to see sellers winning those battles. We want to see buyers winning the battles near the bottom. And this goes the same as the trend lines. If the sellers are not winning the battles up top, you could be looking for a resistance break. If the buyers are not winning the battles convincingly at support, you could be looking for that support break. So essentially the exact same thing as the trend lines. The rejections in resistance should be high volume. If they're not, you can look for a break, which should be high volume and should include a strong price move to the upside through that resistance. Same thing for the downside. Those bounces, if we're looking at support as a bullish bounce area, those individual bounces should be strong. If they're not, you can look for a break of support, which should have a strong price candle paired with a strong volume surge. Okay. We are almost done here, guys. We've talked a lot of game today. We have talked a lot of game. There has been a lot of charts, a lot of setups. While I'm talking through wrap up, feel free to drop any questions in the camp chat. I'll do my best to get to them right after I do the wrap up. So I want to say thank you guys for tuning in. I appreciate it a ton. We're going to wrap things up here. I'll answer any questions in the chat. But biggest thing is a massive thank you to you guys for tuning in. I love talking about this stuff. I love talking about VPA. I love talking about setups. I love talking about when to enter trades. I love talking about where to put your stop losses in trades. I love talking about all of that stuff. So I hope you guys are feeling that as well. Some enjoyment here, learning some new stuff. I hope you guys have had a good time. We got one more class tomorrow, which is going to be the my trading strategy. So I'm going to talk a little bit more time specifics, like what time of day am I looking for what, how am I gonna enter, what setups am I looking to enter, some rules, that sort of stuff we're going to talk about tomorrow. So do not miss tomorrow's class. Anyways, here is the wrap up. The important shit, as always, my favorite section, the important shit. We need to find multiple data points that support your sentiment or trade setup. So combine multiple different things, whether it's high volume rejections and a resistance, or a double top and a weak neckline. All of those things can be combined, and that's what you should combine. Make sure your stop loss is in a smart area. So your stop loss should be below a volume shelf. It should not be sitting in the middle of a desert. Number 3, adding VPA to well-known setups can elevate them from B level to A plus level. That's just a fact. Add VPA and it's going to level it up no matter what. Number 4, confirmation in the form of high volume or retest. So when we see that breakout, we want it to be high volume, or we want it to come down and retest that level to confirm that breakout. Candle closes solidify that price action. Entering before the candle closes puts you at risk of a late candle change. It's also just a fact. If you enter before the candle closes, it could change and it could not look as good. We want to make sure that shit still looks good. So that's the important stuff. And now we have the final message. This class here is really where the rubber meets the road. You know, VPA, OG volume, and volume profile were fun topics to talk about at the beginning of this, and they were the building blocks that led to this class. But you have to be able to put that information to use. And today was kind of the beginning of actually putting that information to use. Tomorrow, I'm gonna discuss my exact volume strategy. But this lesson is a great place to start because my strategy is not going to work for everybody. My strategy is not, it's not a plan that everyone is going to be able to follow effectively. So look for these setups on charts, examine the volume. You can copy parts of my strategy. You can add your own twist. You can toss out my entire strategy. You can copy my entire strategy. It is what it is. Whatever you need to do, find that balance. Because that's how you'll become a trader who understands volume, VPA, volume profile, OG volume, adding setups together to find confluence. And we have one more class to go. So let's show up tomorrow for the conclusion of Volume 101. Let's get after it. And let's finish strong, guys. I'm very, very excited. So again, thank you guys for tuning in. I'm going to answer a couple questions, and then we're going to get out of here. So thank you, thank you, thank you, thank you, thank you. This was volume trading setups in Volume 101. All right. I appreciate the kind words, guys, in the chat there. I see a couple questions here. Number 1, do you ever do any swing trading? I do. I actually do quite a bit of swing trading. I usually have about 5 positions open of swing trades at a time. Wondering if you look at anything differently in a swing versus your daily trading strategies. Do you find any of this way more important or way less for longer time frames, or pretty consistent across time frames? Thanks. Yeah, so for swing trading, what I would say is different is you're gonna need the best of the best when it comes to swing trading. So when it's these day trading, the scalping setups, I'm only needing a couple candles, which on SPY, a couple candles are going to be 50 cents or whatever. I only need SPY to move from 515.50 to 516, which is a very small move. But when it comes to swing trading, you need it to move. If I was swing trading SPY, I need it to move $50. So you need much larger moves. So you need these setups to have 3, 4 things together. You need, if it's going to be a support bounce, you need it to have a high volume engulfing paired with seller weakness, paired with a defense of an EMA. So you need to have multiple things. Yeah, Paul just took the words out of my mouth because I was going to say you also do have to deal with the news coming out. So your technicals need to be even stronger as a swing trader. What I would say, as in just kind of like a good rule of thumb for swing trading versus scalping is, with swing trading, you only take a few swings every few months. So for me personally, my strategy is usually I'm in, like I said, 5, but I'm only adding a new one 10 times a year because I'm selling one every month or 2, and then I'm adding one to take that one's place. So spend way more time analyzing charts to find swing trades because I can take a scalp with a double top and high volume rejection on a 5-minute chart and make money in 10 minutes and be out of it. And then it can go back up and break that double top. But if that was a swing trading setup, it doesn't have the same validity as in if it's only a double top with high volume, it's not quite everything that I need it to be. I would want the 200 EMA to be near that double top. I would want the high volume rejection and then buyers not having any sort of success on those candles. So I would say just take your swing trading setups to a higher degree. Expect more from them is kind of what I think the biggest difference is between swing trading as a volume-based trader and day trading as a volume-based trader. And I do talk about that tomorrow. I have an entire section on kind of the differences between swing trading and day trading. I think it might be the last section tomorrow. But I go into some of that a little bit deeper, as in, why day trading is a little bit easier and why those 3 or 4 candles that we're trying to get momentum-wise on day trading is using setups that would not work as a swing trader. I hope that answers your question, Yeti. Have a good one, Paul. Okay, question from Coco here. Can you explain how a daily candle with less volume could still be larger than one with higher? Like 5 mil volume day red candle, next day 800K green, but it's larger body. Yeah, so it essentially just means that there were less overall traders interested, Coco. So it's similar to like on a 5-minute where we talk about those invalidated candles. That daily candle, that next day green, 800K with a larger body would be an invalidated candle because when we think about it in terms of effort and results, the red candle the day before, there was a lot of effort and it attained a certain amount of results. And then the green candle after it, lower volume. And also, let me preface this by saying, unlike the market when we're in a bull market, this is a completely different story because a bull market, low volume melt up situation, things can just low volume move. But when we're on a trade where it's normal charts where it's a 5-minute or an hourly or a daily or a weekly on something that is not just low volume melting, those green candles, how that happens is where it's a low volume candle, but it's larger. How it happens is there's just less resistance overall. So the sellers either used a lot of their reserves or they just didn't have much interest in the price. And so the bulls, they didn't have to put a lot of effort in, but they were able to move the price fairly quickly and with a decent amount of success. What that tells us going forward is that even though the sellers were not really present during that day, it doesn't mean that they're weak. They could have simply not really liked the price or the price action. The next day, they could love it a lot, and that high volume that they previously had can come back in. And if that high volume that they previously had comes back in, then the bulls just used some buying for no reason to push that price up. So yeah, there's essentially, it's invalidating that smaller volume candle if it's larger than the higher volume candle previously, due to the fact that they just did not have to use as much power to get into that, and it's easy to move back through. The other aspect of it is the resting orders in that area. So that 800K green volume on that green candle, I like to think of it as ladders. So on a small candle with higher volume, the rungs of the ladders are going to be very, very close together. So when they come back into that area, each of those rungs are, 100K orders or whatever it is, or 10K orders. So there's a lot of rungs to get through. And every time they break through one, they hit another one and they have to break through that one. They hit another one, they have to break through that one. They hit another one, they have to break through that one. On the 800K green day, there's a lot of space between each rung or between each order where, they hit that and then there's some space. And so then they get to move it down with less volume and then they hit it, move it down. And there's a lot of space between each rung of the ladder. Which those rungs are those block orders or resting orders. Yeah, no problem. I hope all this information helped you guys. I'm gonna get out of here. Thank you for tuning in.